Today is Thursday, and if you own physical silver, what is happening in the global financial system right now could end up being the most important day of this decade for your wealth. This isn't about a cute little $1 move on the chart. This is about a system that has run out of time, run out of trust, and most critically, run out of physical metal to back its own promises. Central banks, governments, bullion banks, and paper traders have spent decades building a tower of IOUs on top of a shrinking pile of real silver. On Thursday, that tower stands inches from its breaking point. In this video, I'm going to walk you through why the global money system is now mathematically trapped, how silver ended up at the exact crossroads of monetary panic and industrial necessity, what happens when the paper promises can't be met with real metal, and why, if you hold physical silver outside the banking system, this may be the moment everything flips in your favor. This isn't hype. This is about understanding a finite metal inside an infinite IOU system that has finally hit the wall. Before we dive in, a quick but important reminder. This content is educational, not financial advice. I don't know your situation, your time horizon, or your risk tolerance. Always do your own research and talk to qualified professionals before making big decisions. That said, if you value unfiltered macro breakdowns that the mainstream either ignores or shows you when it's already too late, hit subscribe so you don't miss the next update. Like this video so the algorithm can't completely bury it, and share it with at least one person you care about who owns zero hard assets and has no idea how fragile this system really is. Now, let's start with the big picture, the money system itself. Segment 3. The fiat supercycle is ending. For over 50 years, ever since the link to gold was severed, our global money system has operated on one arrogant idea. We can expand debt and print currency forever, and nothing really bad will happen. Politicians loved it because they could overspend without immediately hiking taxes. They could buy votes, fund wars, and bail out crises with newly created money. Central bankers loved it because they convinced themselves they had tamed the business cycle. Every problem could be solved with lower rates and more liquidity. But under that illusion, something very old-fashioned never went away: math. Debt compounding faster than real growth eventually becomes unpayable. Inflation, once embedded in energy, wages, and supply chains, becomes structural, not transitory, and the supposed risk-free asset, government bonds, reveals itself as return-free risk once the real purchasing power bleed becomes obvious. We are now watching this supercycle hit its ceiling. Central banks are running out of credible tools. Rate hikes damage the economy, but rate cuts risk another inflation wave. Confidence in fiat as a store of value is quietly evaporating among the people who move real size: sovereigns, institutions, and deep-pocketed families. When trust in paper breaks, capital runs to hard collateral. That's where silver comes in, and why Thursday matters. Segment 4, why silver not just gold, 9-13 salting. You might ask, if the system is breaking, why not just buy gold, real estate, or stocks? Gold absolutely plays a role. But silver sits at a unique intersection that makes it far more explosive when the monetary tide turns. Silver is simultaneously a monetary metal, used for centuries as money and store of value. A critical industrial metal, absolutely essential to modern technology. Look around you. The 21st century world does not function without silver. It is the most electrically and thermally conductive metal on the periodic table. Every solar panel deployed in the green energy transition consumes meaningful amounts of silver. Every electric vehicle uses significantly more silver than a traditional combustion car. AI data centers, packed with power-hungry chips and cooling systems, depend on silver-heavy microelectronics to avoid literally burning themselves out. Defense systems, satellites, medical devices, 5G infrastructure, and the broader telecom grid all quietly depend on silver's unique properties. So silver's demand profile is dual. When people lose trust in money, monetary demand for silver rises. When the world chases electrification, digitization, and AI, industrial demand for silver rises. You get hit from both sides: monetary desperation, industrial necessity. That's what makes silver asymmetric. If the system muddles through, silver still has secular industrial tailwinds. If the system breaks, silver has monetary upside on top of that. Now add one more factor. The world is using up this metal faster than it can be replaced. Segment 5. Peak silver and structural deficits. Here's the part almost nobody on TV wants to talk about. You can print dollars, you cannot print geology. The physical silver market has been in multi-year structural deficit, meaning annual demand has exceeded annual mine supply and recycling. Stockpiles have been drawn down to bridge the gap. We are effectively eating through the savings account of above-ground silver. On the mining side, primary silver mines have been heavily depleted. The easy rich ore is gone. Ore grades are falling. Miners have to move more rock to get the same metal. Costs are rising due to structural energy inflation and tighter environmental regulations. To make things worse, roughly 80% of silver production does not come from primary silver mines at all. It comes as a byproduct of mining base metals like zinc, lead, and copper. That creates brutal inelasticity. If global growth slows and demand for copper and zinc falls, those mines scale back. When they scale back, the byproduct silver disappears too. Just when monetary and industrial demand for silver spike, mining supply gets choked off. That's how you get a multi-year structural deficit that is mathematically impossible to resolve quickly. You can't just flip a switch and open a dozen high-grade silver mines. Permitting timelines, environmental rules, capital investment cycles, they all run on multi-year horizons. Short-term, the only way the system has kept up is by draining above-ground inventories, leaning harder and harder on the paper market to maintain the illusion of abundance. And that illusion is where things get really dangerous. Segment 6, the paper-silver illusion. On the surface, silver looks like any other liquid financial asset. You see a price on a screen and assume that's a simple reflection of supply and demand. In reality, the global silver price is being set by two main paper venues, COMEX in New York, LBMA in London. Over time, these paper markets have applied fractional reserve logic, the same logic that broke the banking system, to a physical commodity. Here's what that means. For every 1 actual ounce of silver in a verifiable vault, there can be dozens or even hundreds of paper claims, derivatives, swaps, unallocated pooled accounts, and futures contracts referencing that ounce. Traders flip these contracts back and forth all day, mostly settling in cash, not in metal. Large bullion banks build naked short positions using size to push price down, trigger stops, and maintain the appearance of a well-supplied market and a strong fiat currency. Gold and silver veterans have been warning about this for years. The paper market has become orders of magnitude larger than the available deliverable metal. It is a closed loop of digital IOUs until someone actually insists on getting the metal, and that's the critical shift happening now. Segment 7. When users demand metal, not cash for a long time, major players were happy to roll contracts, take cash settlement, and treat silver exposure just like any other financial position. But that only works as long as physical supply is plentiful. Industrial users trust they can always source at some price. We're now in a different phase. Industrial buyers who need silver to build products are increasingly saying, "We don't want your cash settlement, we want the metal." They are standing for delivery on exchange contracts. They are drawing down warehouse stocks at a pace the paper market is not designed to handle. At the same time, sovereign and institutional players shifting away from the dollar system are quietly accumulating physical reserves. They are removing metal from Western vaults and moving it east, into jurisdictions like China, where it is not easily rehypothecated back into Western paper games. The Shanghai market increasingly trades silver at a premium to Western paper prices, precisely because it is anchored in physical settlement, not infinite leverage. So you have a widening gap between the derivative price created by leveraged paper flows, the real-world scarcity experienced by industrial users and sovereign accumulators. That gap cannot widen forever. At some point, something breaks. Segment 8, de-dollarization and the Eastern Vault drain. Now layer in the geopolitical shift. The aggressive weaponization of the US dollar, sanctions, asset freezes, cutting countries off from payment systems, sent a very clear message to the rest of the world. Your reserves in our system are not really yours. When foreign reserves at Western banks can be frozen with a keystroke, leaders in the global south and among BRICS nations draw the obvious conclusion: fiat held in someone else's jurisdiction is not a risk-free asset. It is a liability, dependent on political goodwill. So they respond by reducing reliance on the dollar in trade where possible, de-dollarization, by building reserves in tangible assets, gold, silver, commodities, strategic stockpiles. This is not a meme. It is a slow, steady drain. Metal leaving Western vaults, metal being shipped east, metal being held in systems that are less transparent to Western markets. As this continues, the amount of good delivery metal actually available to back paper claims in New York and London shrinks. The paper claims don't shrink. The backing does. That tension is like a spring being compressed a little more every month. Segment 9, Thursday. The inflection point scenario. So where does Thursday come in? Why frame it so dramatically? Think of Thursday not as some magical date circled on a calendar, but as a symbolic convergence point where several trends can collide. Delivery deadlines on futures contracts bunching up. Industrial users insisting on actual metal, not cash. Sovereign flows quietly removing more physical from Western warehouses. A fragile paper market already stretched by leverage, margin hikes, and prior volatility. Now imagine this scenario. A set of large contract holders stands for delivery. Bullion banks go into the market to source the metal. They find that inventories are thin, premiums are spiking, and offers are scarce. At some point, a bank has to admit, we cannot source enough physical to meet all of these legal claims on time. That's what's called a failure to deliver. Legally, exchanges can respond with force majeure clauses. Cash settlements at some fair value instead of physical delivery. On paper, that sounds neat and tidy. In reality, it is the moment the whole world sees, wait, the silver that was supposed to be there isn't there. Confidence in the paper price collapses. Participants demand higher and higher prices to part with the real metal they actually hold. Price discovery doesn't move in a straight line. It gaps violently. Segment 10, what a break looks like. If and when the paper system cracks, it won't look like a gentle, well-behaved rally. It will look like paper shorts scrambling to cover in a market where nobody wants to sell physical. Spreads between spot and physical premium blowing out. Eastern markets trading far above Western derivatives. You could see the spot price on a screen double in a sickeningly short period of time, yet real-world dealers either completely out of stock or asking multiples of that screen price for what little they have left. This is how a wealth transfer happens. Those who trusted the system's IOUs get stuck in cash. Those who quietly built positions in real metal before the break own something the system suddenly needs and does not have. It's not about day trading a spike. It's about being on the right side of a reset in what the market believes silver is actually worth. Segment 11. Historical echoes. Fiat always goes to zero. If this sounds extreme, zoom out. History is full of fiat experiments. The Roman denarius, the Weimar papier mark. Countless hyperinflations and currency collapses. The script is always the same. Governments overspend. They paper over deficits by degrading the currency. The middle class gets squeezed as purchasing power quietly dies. Eventually, confidence snaps and money rushes into hard assets. Every purely fiat currency has eventually gone back to its intrinsic value, zero. The difference this time is the global scale of the experiment, the speed at which information and capital can move. In a world of instant payments and 24/7 markets, once the psychology flips, the window to reposition shrinks from years to months to possibly days or hours. By the time mainstream headlines say silver is exploding on shortages and de-dollarization, the real physical market may already be frozen. Segment 12. What this means if you own silver. If you already own physical silver in your own possession, what does all this mean? It means you're not in a get-rich-quick scheme. You're holding insurance against the failure of a debt-soaked fiat system. Your job now is to make sure your metal is stored safely, outside the banking system and away from rehypothecation. Understand that volatility in the paper price is part of the process, not a verdict on your decision. Avoid the temptation to trade in and out based on short-term price swings that are driven by margin and leverage, not fundamentals. If this system does what every unbacked system has done in history, your silver won't just be some shiny collectible. It will be part of the foundation on which the next monetary arrangement is built. Those holding real, unencumbered metal become the creditors to whatever comes next. Segment 13. What if you don't own any yet? If you're watching this and you own no physical silver, the message is not panic buy at any price. The message is recognize that our current system is structurally fragile. Recognize that silver sits at the intersection of monetary mistrust and industrial dependence. Recognize that paper claims can be printed, but metal cannot. Then ask yourself, how much of my net worth is sitting in assets that can be frozen, printed, or inflated away? And how much sits in things that cannot be created with a keystroke? That doesn't mean go all in. It means consider whether some allocation to physical precious metals is warranted as insurance, not speculation. The worst time to try to buy insurance is after the house is already on fire. Segment 14, closing message and call to action. Thursday might or might not be the exact day the paper-silver system finally buckles. Markets rarely respect our calendar, but there will be a day, whether this Thursday or some Thursday soon, when physical delivery demands collide with an over-leveraged paper system. Confidence in IOUs evaporates faster than central banks can speak, and the world is reminded that you cannot build a durable monetary order on infinite promises and finite metal. If this breakdown helped you see the structure behind the headlines, hit like so this message gets out beyond the tiny circle of people who already understand it. Subscribe so you don't miss the next update as this situation develops. Drop a comment. Physical held if you already own silver outside the system. Just starting if you're new and learning. No confidence in fiat. If you see where this is heading long term, hold your wealth in things that obey the laws of physics, not the whims of politicians. Stay calm, stay informed, and I'll see you in the next update.